Ladies and gentlemen, distinguished guests. My name is Georgina Athanasiou, and I am an associate of the Banking and Finance team at Kyriakides LLC. With a great pleasure, I welcome you to today's webinar, which is the second edition of the NPL Days focusing on Cyprus. The webinar is organized by DD Talks. DD Talks is determined to bring a fresh perspective on engaging the audience and deliver the latest industry updates and tips. We have a very impressive panel today across the financial sector, so please allow me to warmly welcome the participants for being here with us. Mrs. Evgenia Christodoulou, Managing Director of B2 Capital Cyprus. Mr. Lambros Papadopoulos, Chairman of KEDIPES. Mr. Tassos Kotzanastassis, Managing Director of 8G Capital Partners. Mr. Afxentis Zemenides, Director of Afxentis Zemenides Financial Services Limited. And Mr. Vasilis Theofanopoulos, Managing Director of Mount Street Hellas. Welcome to our today's discussion. Ladies and gentlemen, it is a fact that Cyprus has one of the highest rates of non-performing loans in Europe. In recent years, there has been a reclassification in the banking system of Cyprus due to the high growth rate of non-performing loans, since their role is crucial for the entire economy of Cyprus. NPLs are a problem for the economy as they limit the growth of the banks and their ability to contribute to the recovery of the economy by granting new loans. They utilize resources and they undermine confidence in banks, and confidence that is essential to financial stability. NPLs sold to investors may reduce the level of the problem for banks, but this practice does not solve the problem. The borrowers, and therefore remains a problem for the wider economy. Time is running out, and the solution to NPLs problems must be found urgently. Today's discussion focuses on NPLs, and particular on the remarkable achievements and ongoing challenges in this area. These issues are important both at local and European level due to the interactions of the economies. Before we proceed, let me quickly explain how the structure of our webinar will be. The discussion will be based on 5 topics. Specifically, I will be raising a question to one of the speakers, and the speaker will in turn have up to 8 minutes to express his views on the topics and answer the question. Then the other speakers will have the opportunity to comment on the position of the previous speaker. Each comment will take up to 1 to 2 minutes maximum. So let's start our discussion with the first topic. The question is now addressed to Mr. Vasilis Theofanopoulos. Mr. Theofanopoulos, could you please tell us your forecast on the non-performing loans, given the fact of the recent decrease of the non-performing exposures? Mr. Theofanopoulos, the floor is yours.
Thank you. Very briefly, it is an interesting question, and it's interesting because it's quite difficult to predict these days. You have all these different factors weighing in. I think ultimately it's about what's going to happen to the economy. I think for Cyprus specifically, Cyprus has the highest also degree of or percentage of loans that is in a moratorium. I think it's almost double the next one. So we will only start to actually uncover a few of the issues on balance sheet later on in 2021. The reality is that I think the important question is the policy response. And the policy response, the intended policy response is quite forceful from the European Union. I think Cyprus is going to be getting around 11% of its economy in grants and loans. That is ample to bridge over all the economic entities that are in trouble, but it needs to pass, and we are in those days that this is happening. I think the other factors that make the question quite difficult to answer is that at the same time you have a pandemic that you see once in 100 years. You have Brexit that you see once in half a century, and then you also have other factors coming through, specifically for Cyprus, the end of the visa program, which I think is also impacting certain aspects of the real estate market. And obviously, on the business NPL side, where we focus, you have accelerating growth. The pandemic is going to go away, and we are now confident around that. But the impact on the retail sector and the way we work and how much we travel is likely to stay with us, and those elements are likely to persist. So I'm more hopeful on the retail NPLs. They are going to be worked out much easier, because there is an understanding that this is not a morality play anymore. People struggle because of no fault of their own. And I think Cyprus, the retail NPLs are really the bulk of the new issues. On the business NPLs, I think you're going to have, ideally, you would have a day of reckoning where non-viable entities will be cleared out, and then capital is going to be flowing into businesses that have a plan to get out. And hopefully that needs to happen. Of course, every new solution that gets introduced, whether it's good or bad, it just takes time to implement. And time, there are two views. You said that time is running out. Unfortunately, there are a lot of actors that don't agree with you. They just don't agree that time is ever running out. But the reality is that we're missing a lot of opportunities, both in Greece and in Cyprus. So that's my assessment. I think it's going to go up, but it's not going to be as bad for Cyprus.
Thank you very much, Mr. Theofanopoulos. Dear speakers, you now have the opportunity to make your own comments if you wish. Does any one of you want to make a comment to the position of Mr. Theofanopoulos? Okay.
I think, Georgina, if I may, there's an interesting reference point that is coming out of Greece. All four systemic banks have spoken about their expectations about how much of the non-performing loans, how much of the loans that are now in moratorium could turn into non-performing. And they gave a reference of 20 to 25% of the loans. Obviously, Greece is different to Cyprus, and as Vasilis rightly explained, Cyprus, a lot more loans are in moratorium than in Greece. But if we are to apply that 2025 in Cyprus, the figure it could be as high as 2.5 billion as such. We at KEDIPES, we have about 700 million of such loans in moratorium, which we do expect that some of them will also be turning into NPLs, but we are hopeful that due to the structure of these loans, some of them are even civil servants, for example, we are going to avoid them turning into NPLs. Thank you.
Thank you very much. Does anyone have comments? Perfect. So we can move on to the second question. As stated, about half of the total performing loans are in a moratorium until the end of December 2020. Mr. Zemenides, as a service provider to both local and international clients, with main purpose the negotiation with the banks for finding solutions relating to non-performing loans, I would like you to develop your views in a series of matters. More specifically, from your point of view, how does the way the banks and servicers behave during negotiations affect the borrowers in reaching a solution for non-performing loans? Does the reduction of prices of real estate affect the efforts in reaching a solution for an NPL? What can be done to speed up the time frame which is needed in reaching a solution regarding NPLs, and what do we expect to happen regarding the NPLs after the end of the moratorium in January 2021. The floor is yours.
Thank you, Georgina. Hi to everyone. First of all, I would like to thank DT Talks for giving me the opportunity to take part in the discussion on today, together with the distinguished panel. Our firm and me personally have been involved in NPLs since the inception of the concept here in Cyprus, almost a decade ago. So we have a lot of experience on this aspect, on this issue from both sides, from the side of the banker, ex-banker, and from the other side of the consulting borrowers with NPLs. Next January, we are expecting a new wave of NPLs after the end of the moratorium. According to the figures of the central bank, 50,000 borrowers, both households and the businesses, requested last April to stop making payments towards their loans for a period of 9 months, which is ending now in December. This was the maximum time period allowed by the European Banking Supervisory Authority. So the borrowers cannot ask for further relaxation, let's say, with their payments starting from January. So I expect that we will have a new wave of NPLs, since the pandemic has not ended yet. And this will be, I think, a problem for the banking sector. And the head of the SSM last week sent a letter to the banks in the Eurozone, asking them basically to evaluate their clients and categorize them, those that they are viable and those that are not viable, in an effort for the banks to make an assessment of their portfolio, loan portfolio, and see what they can do after January. In Cyprus, the value of the loans is amounting to almost 12 billion euros. That is almost 47%, sorry, of the loans are in moratorium. So you understand that we have, I believe personally, that we have a real problem. I know that the bank said that they don't expect to have huge problem, but from my experience and from the, let's say, the contacts with various clients, I believe that we will have maybe not the same problem, let's say, that we had back in 2013, but if you take into consideration that the tourism industry has not yet, is not operational and will not be operational until the earliest next spring. It means that all the hotels, they will have problems with their loans. The restaurants and other businesses. Ideally, the banks will have to examine each borrower, so case by case, and talk to them, because as I said, we have a new wave of non-performing loans. you know, Cyprus, together with Hungary and Portugal, they have the highest percentage of their loans that they are in moratorium. So there was no evaluation by the banks before allowing the borrowers to stop paying their loans. So everybody applied to the bank, and the bank accepted these requests of their clients. Well, regarding the problems that I see during the negotiation between the borrowers and the bank or the servicer, usually we see that there is not enough flexibility from the side of the bank or the servicer in the efforts to reach a solution. The usual question that we get from the clients, they say, why a bank doesn't write off part of the interest of a loan, and it prefers to sell the loan to a service provider at 20%, let's say, of the book value, while we could find a solution between us. The other thing that makes difficult in finding solutions to the NPLs is the reduction of the land in the real estate prices. It is difficult for the clients to digest the fact that the prices of the land has been reduced substantially since the booming years of 2007 and those years. We of course explained to them that it's a matter of supply and demand in a free market, so we cannot blame the banks. So our role is to try and bring the two sides together. We need more flexibility from the banks. From the other side, the clients have to understand that the prices of the property which they have mortgaged has been reduced. So they have to, in most cases, they have to provide assets to the banks or to the servicers in order to reduce their loan exposure. So I think we need both sides to come together in order to find solutions. And believe me, there are people out there which are not strategic defaulters. They want to find a solution because all the situation with the NPLs, they have created problems, financial problems, health problems, personal problems, so they want to finish with this. So I think these are the factors that they have to be taken into consideration by both sides in order to speed up the resolution of the NPL issue. Thank you.
Thank you very much, Mr. Zemenides, for the very interesting position. And do we have any comments from the other speakers? No? So we can move on to the third question for today. From time to time, various solutions are heard regarding the issues of non-performing loans in Cyprus. Mr. Lambros Papadopoulos, is a European bad bank or a national bad bank, as currently contemplated by the European Central Bank, the long-term solution to the Cyprus banking non-performing loans problem? Mr. Papadopoulos, the floor is yours.
Thank you, Georgina, and please allow me to also thank DD Talks for inviting me to be part of the panel for this very important topic. I think the way to answer your question is by breaking it down to three parts. Let's start with the last part, which is the problem itself, the Cyprus banking NPL issue. Allow me to start by saying that a lot of good work has been done in the last 6 years by the Cypriot banks in that respect. We moved from an NPL of 27 billion at the peak in 2014 to now having NPLs just below 7 billion in the banking system. Obviously, part of that is because some of the NPLs have moved to the credit acquiring companies, including ourselves, KEDIPES, where we now manage about 6 billion. But nonetheless, if you look at the gross deleveraging of NPLs, it is even more significant than the 20 billion. There has been a good 5 billion from repayments and even as much as 7 billion from cures, in addition to obviously the write-offs that took place. We're still left with 7 billion, of which about 5 is now with the systemic banks. If you look at the NPL plans of these systemic banks, they were expecting that number to go down to 3 billion by the end of 2022. Obviously, such plans have been derailed by the pandemic. As mentioned earlier, the problem is not just what we have now, is what will also be created once the moratorium is lifted. And I mentioned earlier, gave an indication of a number as much as 2 to 2.5 billion that could be coming out of the loans in moratorium. Hopefully, obviously, less. The issue here for the Cyprus banking system is how much coverage of those NPLs they need to take and how quickly they need to take provisions to bring the coverage up. I'm afraid, and I will be quoting the chairman of the ECB Supervisory Council in a recent letter that he sent to the European Parliament. The ECB does not favor a wait-and-see approach. We knew that all along. And they don't even favor a more lenient coverage ratios this time around, despite any flexibility they're likely to be showing on the proposed NPL plans of the banks. So we do have a serious issue ahead of us. And while we need to hope for the best, I believe we need to prepare for the worst. So looking on to the solutions, as you mentioned, there has been always talks about the European bad bank. And staying with Mr. Andrea, he was the biggest advocate of that. And he has been talking publicly about the solution coming out of European bad bank as such. But some of his other ECB officials, including officials from the Single Resolution Board, have been less enthusiastic about the potential of a European bad bank. Let me remind you that we're still missing the third leg of the banking union, which is the European Deposit Insurance Scheme, and not to mention the elusive dream of the South European nations with high NPL problems of mutualization of sovereign debt that never actually took place. Need also add that the problem is not as acute in Europe as it is in some of the southern countries like Greece and Cyprus. European banks could also resist the potential of a European bad bank. Bear in mind the NPL ratio at Europe is around 3% only. Compare that with 22% in Cyprus and even higher than is in countries like Greece. So for sure, it is desirable for a country like Cyprus and with other countries with high NPL problems that the European-wide bad bank is created, and it will be heavily supported by the various stakeholders. But I think the chances of this happening are very slim, in my opinion. And the best we may get, again, quoting Mr. Andrea, in a recent interview he gave to the state television in Greece, ERT, he spoke about a mechanism that allocates losses to member states from a common European initiative. And a common European initiative that is likely to have the foundation of that the national asset management companies. So coming to that, let's think a little bit about how you can solve the problem of NPLs in Cyprus. Theoretically, you have one of 4 solutions. Solution number 1 is the ECB allows time. And the picture turns out to be not as bad as we all fear, but I'm afraid that is probably the least likely scenario. ECB doesn't really like allowing time. They don't favor, as I've said, the wait and see approach. And history, as Afxentis just mentioned, is not on our side in terms of creation of NPLs. The second solution is that the banks raise any additional capital that they need, Tier 1 capital, from the private sector, which could be the ideal scenario as well. A limiting factor here is the fact that the market cap of the systemic banks in Cyprus is less than 600 million, which means that it could be a very heavily dilutive increase rights issues at the banks. The third option is securitization, where the framework is in place in Cyprus as well. But again, the small absolute size of the problem in Cyprus is a major mitigating factor behind securitization structures for this tool to be used. And need not mention that it would need government guarantees, which are, obviously impact the national debt and could be significant. And the guarantee itself is as good as the investment grade rating of the sovereign that is underlining such guarantee. There is a vicious circle here as well. And the issue of NPLs is probably the single largest risk to a downgrade that Cyprus has by the rating agencies and the loss of the investment grade rating of Cyprus, which is critical for the government that it gets preserved. So it takes me to the fourth solution, which is the solution of the creation of an asset management company. As I mentioned earlier, there's no official guidance from the ECB. And in fact, we need to go back to March 2018 to find something official from the European Commission. And there is a blueprint by the European Commission on their guidelines for the reduction of NPLs in Europe, which provided specific guidelines and references for the creation of national asset management companies. That blueprint gave some key principles, which I will quickly touch upon. The first one is that the national asset management company needs to have a clear and unambiguous mandate. The transfer of assets into it should be at market value. State aid should be avoided or minimized, and it should be within the parameters of the provisions of the frameworks on resolution, like the Banks Recovery and Resolution Directive. Then this asset management company can do what other national asset management companies in Europe have done, like NAMA, which is being able to add to their balance sheet by taking more assets from troubled banks. And it needs to be provided with the right governance structure, the right organizational structure, be independent from the state, and have fully engaged in-house NPL servicing facilities or facilities by third parties. And last but not least, it needs to have the right legal framework in place, and the right legal toolkit for addressing the NPL issue in the first place. So once these conditions are met, I do believe a national asset management company can become a reality and can be part of the long-term solution of the Cyprus banking NPL problem. To conclude on the issue, please allow me to spend a minute on KEDIPES, because that's quite relevant to what we've just discussed. In the 2 years since we've been set up, and despite having initial licensing issues, and despite the pandemic, we have managed to deleverage our loan portfolio, which is as big as 7 billion, by 20%, if we exclude accrued interest, with the support of our third-party servicer, which is Altamira. We have repaid 280 million to the state in cash, which is about 8% of the state aid that we have received at the time. If we actually add the real estate assets we're giving back to the state and the liabilities we took over from the state, including an asset protection scheme at Hellenic Bank and a voluntary redundancy scheme that took place at the time, as well as taxes that we pay when we do restructurings, we have actually taken off the state as much as 700 million. So quite significant achievements to date. And we have also made significant progress on our governance and organizational structure, fulfilling the DG commitments, the European Competition Authority commitments that we operate under. Finally, we have initiated Project Lidra, which involves the disposal of a performing and restructured portfolio of about 1 billion of assets. Under its commitments to Digicom, KEDIPES has the sole purpose of managing now the portfolio of the ex-cooperative bank. If the national and the European authorities allow us, we can certainly play a role in the creation of an asset management company. Thank you.
Thank you very much, Mr. Papadopoulos, for giving us a full picture of the solutions to this problem. I now give the floor to the other participants to make a comment if they wish. So we do not have any comments, so we can move on to the next question. Mrs. Evgenia Christodoulou, having in mind your specialization in financial services, including the management of non-performing loans, I want you to move on to the matter of selling or outsourcing NPL portfolios to services. So my question to you is, how can the loan services increase secondary loan market efficiency? Mrs. Evgenia Christodoulou, the floor is yours.
Thank you, Georgina. I'm very happy to be here today. You have definitely chosen a very hot topic, has been and it will be. Thank you for the question. I've prepared a presentation which I can share with you because I actually find it easier to look at things on screen. And I will be starting. Hold on, can you actually see it now?
Yes.
All right. For the purposes of your audience, maybe I can briefly go through the general picture and the general environment. Some of the things have already been mentioned and covered. Just to say that a credit acquiring company is a company that is authorized under the relevant legislation to acquire credit facilities, to buy or service non-performing loans. And this has become possible following the introduction of the sale of credit facilities law, which has paved the way for this with considerable benefits in the Cyprus economy, as has been mentioned and as we will see later on. Credit acquiring companies can either purchase and or service credit facilities. So the picture in Cyprus currently is that 7 companies are already licensed by the Central Bank of Cyprus. B2 Capital was the first one to be licensed. And apart from the 6 companies that you can see on the slide, there is also Pepper. And on this slide, you can see the servicing landscape, whereby these companies don't actually own, or they might own, as in the case of B2 Capital, and service at the same time. You can see the top 3 players in the market that you're all aware of. And we expect that the demand for services will continue for all sorts of reasons, both due to the evolvement of the non-performing loans, but also due to the benefits that these companies can provide with. Now, the key players in debt purchasing, as you can see, Apollo acquired a very large portfolio, Helix 1 from Bank of Cyprus. B2 Capital has 2 portfolios, one from Hellenic Bank and one from the Bank of Cyprus, which has been acquired during this year, 2020. And APS, which also bought back in 2017, if I'm not mistaken, from Bank of Cyprus. Now, non-performing loans and the way we see it. This is, as Lambros mentioned, the evolution of the non-performing loans as per the bank's balance sheets. So we have had a remarkable reduction compared to what we had back in 2016. Rates are approximately at 1/3 of what they used to be 4 years ago. There were, of course, repayments, but a very big part of this reduction is the sale of non-performing loans to acquirers, with the cooperative having, of course, the most significant impact in 2018. Now, unfortunately, I'm not. We are not that optimistic regarding the NPL picture following the COVID crisis. Even though on a European level NPLs fell from 6% to 3% over a period of 4 years. And the banks had indeed started 2020 with a much stronger capital ratio. We feel that the post-COVID effect will probably double the NPL problem. Here you can see in blue, sorry, I'm missing the index. In blue is non-performing loans in some of the major countries in Europe, non-performing loans in 2019. The light blue is non-performing loans plus what was estimated as amounts unlikely to be paid. And orange is the forecast, the post-COVID forecast, which well, it's more in some, less in others, but comes to sort of 2 times what we are experiencing today. Government debt is expected to, of course, to significantly increase. Consumers are tightening their budgets, and we've seen a rise in savings, which is not expected to continue. Unfortunately, these are expected to gradually be depleted. And we see an increase in unemployment and inflation, and all this leads to an increased investment risk and cost of capital. Now, the debt purchasing market, I think it was you, Georgina, who mentioned at the beginning that it's good to evolve and mature in these markets. And here we can see that some countries are at a very mature stage regarding the debt purchasing industry, whilst others, including Cyprus and Greece, are still at the early stages. The maturity stage is very, very important because it leads to the impact on the economy and banks' performance and balance sheets. So when you're at the early stages of maturity, there are not that many NPL sales happening. Prices of purchasing these portfolios are kept at low levels, and typically you would see a wide gap between the bid and asking price, a typical characteristic of a not so mature market. Because the market is not geared towards such transactions, there's a weak quality of data, which is very important to these type of transactions, both at the valuation and at the managing and servicing levels. And typically you would find that early adopters include consumer finance and international banks. It's also a cultural thing. I think we have seen that in Cyprus in the talks in the past regarding sale of portfolios. Now, when you get to more mature stage environments, then sales start to deplete the NPLs that are within the banking system, and at some point start to exceed it. And then you see this happening on an annual basis. So every new creation of non-performing loan portfolios is instantly sold. This begins to increase competition in the market across the debt purchases, and also makes investors feel more comfortable, and the risk in the markets is considered as lower rather than in the less mature markets. This leads to a decrease in the bid-ask gaps, which of course makes the transactions easier and quicker to complete. At the same time, the credit acquiring companies start to have a share of fresher vintage, as it's called here, which also makes them feel more comfortable in paying a higher price, and also benefits the system more, because we will later on see the effect on the banks. So yes, that's the reason we feel that it was a very good move to open the way in Cyprus for this sector. Now, to your question whether it's selling or outsourcing, actually it has to be both. It can be both, but usually it's good if it's both. Outsourcing may be the first stage that banks could go for, and with outsourcing, just to be clear, we mean bringing in a servicer. The banks maintain the loans on their balance sheets, and they assign the servicing to a servicing platform. This is beneficial for a bank. It's proven to be beneficial for a bank because managing non-performing loans is not a bank's core business. A bank's core business is to utilize the deposits and channel the funds to beneficial lending. Servicing platforms are specialized companies, and they are more geared in collecting non-performing loans. If the banks don't outsource, then they have no other option than to internally manage these loans. And this, of course, as we know, builds up costs, and it's usually fixed costs, which also burden the bank's P&L and capital. In addition, the valuation of such portfolios is not a core business for the bank. This outsourcing allows the servicers to have a clear picture of the portfolio and to be able to provide a fair purchase price following a solid valuation of this portfolio. Now, the next stage, or it could be stage one as well, could be selling of the portfolio. This is something that Afxentis raised when he said that some of the customers are wondering why a bank should sell instead of write off itself. Well, One of the reasons is that by selling, you can, of course, in a very short time, lighten your balance sheet considerably, rather than have to review a case-by-case basis. By selling, the second reason that assets portfolios should be sold when they reach a non-performing state is that assets that have been underutilized, and I'm talking about mortgage property that has been unproductive and derelict, has not been adding much value. The speed with which credit acquiring companies process these assets allows them to bring them back in the system, either by selling them or sometimes even investing in them. And they are, again, in a position to add to the economy and GDP. A third point, which is quite important, especially in the Cyprus environment, which is a small community, is that by selling to another party is quite a good solution to what we call the moral hazard. The moral hazard goes both ways. It could be a case where a bank is reluctant in settling with a write-off because this may spill over to other customers who may also demand the same solution. A credit acquiring company is not concerned with these aspects. It's a quicker approach, and it's not based on long-term relationships as created by the banks and their customer base. Another example on the other side could be that a customer, a debtor, is not cooperating with the bank because they feel that they were not treated properly, or they were unfairly charged. This is not an argument that can be used to a third party once the sale is completed. So these moral hazards that are created from precedents do no longer exist once a bank sells. And finally, after all this, it's obvious that market efficiency is improved when you have developed servicing platforms. Investors have the comfort to invest, to underwrite better, and as already mentioned, they pay a higher price. This then in turn means that there is more money given to banks, which they in turn can invest in the system by further lending. In general, the higher the comfort, the more mature the market, the lower the risk, then the more efficient this secondary loan market becomes, with a win-win situation to all. That's about it from me.
Thank you very much, Mrs. Christodoulou. It is important also to have the views of the other speakers on the aforementioned topic. And does any one of you want to express your thoughts on this matter? If not, we can move on to the last question.
I think, Georgina, Evgenia summed it up very well. Servicing plays a critical part to the addressing the issue. And one thing that has been missing in Cyprus is the regulatory framework for the servicers. But I believe that should also be addressed very soon. And in that way, I think some of the issues that have a reason in terms of the services not being too nice to the borrowers or the services not being regulated, that should also close. So I think it's critical that we get a lot of third-party services like B2, Altamira, Do Value, and I think that's definitely part of the solution in Cyprus.
Thank you very much.
And there is, if I may add, Lambros, that there is a new directive out from the Central Bank of Cyprus, which moves that direction. Effectively, credit acquiring companies are called upon to abide to the same guidelines and regulations as credit financial institutions, which is cumbersome on one side, but it is good. It is good, and it will create a solid environment in the sector. So, yeah.
Thank you very much. Do we have any other final comments on this matter? So, we now proceed to the final topic for today's webinar, and I would like to yield the floor to Mr. Tassos Kotzanastassis. Mr. Kotzanastassis, we would like you to comment and express your views on the very important matter of the real estate transaction, accurate valuation for different asset classes and pricing policies. The floor is yours.
Thank you, Georgina. Thank you to Talks for having me on the panel. A couple of points about ADG Capital Partners. We're a private equity firm with principal and advisory activities. We have offices in Hong Kong, Istanbul, Nicosia, and London. When it comes to NPLs, and particularly in Cyprus, we've been involved in the vast majority, if not all of the secured NPL transactions in Cyprus, working mainly on the buying side. And one of the things we are doing is portfolio underwriting. So what I'm going to discuss today is based on that experience, is based on actual examples. Now, I cannot think of a single example of a portfolio where we haven't seen differences between vendor valuations and actual so-called market values. The difference ranges between 5 and 20%, and I'll attempt to describe some of the reasons behind these differences. The first one is the stickiness in pricing. In other words, the communicating vessels effect. Banks have both performing and non-performing loan portfolios. So if the bank carries out, for example, a valuation for the NPL portfolio that's intending to sell, and realizes, for example, that land prices, land values for prime residential development land have decreased, it will have to reflect that on the performing loan portfolio, which could have some very, very nasty consequences on profitability and capital adequacy. So banks tend to be quite conservative in recognizing the full impact of market movements. And I think Afxentis mentioned about this, that there's some stickiness from both parties. So when we underwrite portfolios, the order of the day is, give me a price that will make this property sell. Give me a price that will clear the market. Forget about past valuations. Forget about vendor valuations. Focus on a price that is going to sell the property. Now, the second problem, and Evgenia mentioned this already, is the availability of data. In many, if not most of the transactions, we found huge gaps in the data tape. So property information was missing, was wrong, was conflicting. In some cases, it was all over the place. To give you an example, practical example from Cyprus, a second home development. You can think of a large residential development with tens of units. Some of them are sold, some of them are resold. The records that the bank had did not reflect the actual situation on the ground. So in this instance, you need to act a bit like a private investigator. You need to try and find the pieces. You need to connect the dots. You need to speak to the developer. You need to do some digging in the land survey. You need to speak maybe to agents who have been involved in the transactions. And in cases of uncertainty, you need to take the most conservative approach. And this leads to what Evgenia described as a very large bid-to-ask spread. A third case where we found significant differences between the two sets of valuations is large properties, right? typically more than €1 million. In Cyprus, liquidity in the property market is by and large focused on properties under €100,000. So as you go above the 100,000 mark, the liquidity in the market is restricted. So you have fewer data points to work with. So any assessment of value becomes riskier. For example, commercial properties. You may have a property in the bank portfolio with a value of 5 million, right? And you don't have many of those in Cyprus. If you look around, look at the comparable evidence, you may have just 1 or 2 properties, and these may have been sold over the last couple of years. So it's quite perilous to arrive at a spot valuation based on such a limited data set. In this case, what you need to do is to have knowledge of the investment market. So you need to know who is active on the market, what is the required rate of return, what are the yields they're asking for. So you need to make an educated guess on the value of such property. Now, the other issue that we have faced is the value of redevelopment properties or development land. The value of property, of any property, is essentially determined by the income it can generate. There's no inherent value in properties, right? So if you have a beachfront property, people say it's scarce, but the value of that property is actually determined by what you can develop and the value of that development. So when we value such properties, we use what is called the residual method of valuation. Essentially, you work backwards. So you start with a finished product, how much you can develop, how much you can sell that for, and you start deducting your costs like development costs, cost of finance, cost of risk, and so on. So the residue, the last number, is the price of land. Now, by the nature of that valuation, the residue, the value of the land can be quite fickle. So, for example, if you stress the final product prices by 10%, you may end up with a land value which may be maybe 30% lower. So it's really, really sensitive. So what you need to do in that instance is to have very good knowledge about the value of the end product. So if we're talking about residential, you need to know the absorption rate, you need to know the actual prices, and it helps to have an agency practice as well. In our case, we have an agency practice, an agency business within the AG group. It's called Elite Blue. It's the Cypriot associate of Vasilis. So we have a very, very good view on what's happening on the ground. Another issue that we're facing is granular properties. Now, if you look at portfolios like Helix, Helix 2, Tide, and so on, in those cases, the Pareto, or otherwise known as the 80-20 law, used to apply. So effectively, you could expect that 75% of the value was concentrated on the top 25% of the properties, and conversely. However, if you start talking about securitizations like Lambros mentioned, in that instance, you would be talking about granular portfolios. So it would be tens of thousands of properties, which would be relatively small, relatively homogeneous, and you have an issue of how to value 50,000 of those properties accurately. Now, the way things have been done in the past was using either indexation. So you say, okay, I've got 50,000 properties, land, residential. I take an index of maybe 2 points of an index and apply those 2 figures across the portfolio. Other methods were statistical. So you would say, okay, I've got 50,000 properties, maybe I'll value 500. And then extrapolate to the rest of the portfolio. Now, as you can expect, the results can be very inaccurate, and we have seen this in portfolios. So a modern way to address that is to use automated valuation models and data analytics. So essentially, we have developed within the AG group this capability. It's a company called Waypoint Metrics. This was developed following the securitizations in Greece. So we started with Project Cairo, and we've done it again with Project Galaxy. In that instance, you use machine learning and a few other artificial intelligence techniques to essentially simulate the way that the valuer will work. So a valuer would take the property, would analyze the information, would extract comparables, and then arrive at the valuation. So this is what you can do using artificial intelligence, and you can value, for example, tens of thousands of properties within 2 weeks. In Cyprus, we've done this for Helix 2, which had a value of 2.8 billion. And as I said, in Greece, we've done this for Cairo and for Galaxy, which is a 10.5 billion securitization. Now, another issue I need to mention about valuations, and this goes for mainly for large properties, is the so-called depreciated replacement cost approach, whereby a valuer would come and say the value of this property is equal to the value of the lands and the cost of replacement. This begs the question, why would the bank lend against the property which has so restricted liquidity that the valuer is forced to use the cost of construction? Okay, but since the property is there, this is something that you have to completely ignore and just focus on the value, the market value, which is determined by demand and supply. If there are no comparables, you need to ignore the cost and focus on how much this property might sell for. And we can find a number of discrepancies there. The last point I want to mention is liquidity and competitive supply. You may have a valuation which says that this property is worth $500,000, for example, and it's going to sell in 36 months because it's an illiquid market. Well, in my mind, a period of sale of 36 months is not a market value. It's something else. Another issue we face is supply and looking forward. So, for example, you may have a valuation in the books which says that, you know what, based on previous transactions and historic comparables, the value in this instance is 150,000. However, if you look at supply, so if you look at what Altamira, what APS, what Gordian are doing, and if you see that there's a number of other properties, similar properties in the market selling for 100,000 or something different than 150, then you're well sure that the value is not what the historic sales tell you. In this instance, the way to go about it is to use data analytics and take, again, liquidity into the mix. So what we do is we follow the supply coming from all the institutional sellers. We understand what they're doing. We see the pricing strategies. So we analyze where they give discounts, where they have sales, and so on. And we put everything into a mix, and we try to use predictive pricing approaches to understand if you put the property into the market, how much it can really sell for. That's what I had to say in a nutshell. I'm very happy to take questions.
Thank you very much, Mr. Kotzanastassis. Do we have any comments or questions by the other speakers? No? Okay. At this point, the different stands on the 5 topics have been completed. And many thanks to the speakers for their very perceptive input. I will now give the floor to the speakers for any concluding remarks.
Hi, so thank you. I think it was all very interesting, and thank you for inviting us as well. One thing I think to note is that ultimately in the NPL market, you have quite a lot of different animals kind of bundled together, the retail side and the small business loan side and the SME side, which I think is actually quite crucial for the economy, and the ability of servicers to mobilize capital in a time-efficient way will actually determine in the end how successfully the whole policy around servicing, outsourcing, or whatever asset management companies, that ability to mobilize capital into the less liquid parts of the market will determine success. And I think that is kind of what underlies all of the approaches. So thank you again.
Thank you very much. Do we have any other comments?
Georgina, I have a question to the other panelists, which are not property people. My question to you is, what are your expectations as regards property prices? Are you concerned that the oversupply or the supply of properties coming out of services is going to have a downwards impact on pricing?
I think in Greece, there is a lot of impetus, and hopefully after the pandemic, this would not be affecting most sectors. I think there are sectors in Cyprus that are going to be affected because of the oversupply and other developments in the economy. Again, it has been proven that unless the market finds a price where the actual holder is happy, it's not easy for the market to start changing price points. And the practical nature of it is that a lot of these loans still sit with the risk still sits with banks effectively, or institutions that have low cost of capital and can wait for the right number. I think once you see a lot of economic risk sitting with high cost capital owners, then you're going to see more movements. So we're not there yet, I think.
But if you think about it, the pricing of any good is determined at the margin. So if you sell 100 shares of a company today, is that transaction that's going to affect the pricing. So even though the banks can afford to wait, high cost of capital investors have business plans, and they have given time frames during which to sell. And at this point in Cyprus, it's these investors who are controlling the supply. So do you see a risk, Vasilis, in that in order to fulfill those business plans, they'll end up offering discounts and as such driving down prices?
I think that you've seen that in Greece, the large synthetic securitizations that are going on, 96% of the economic risk remains with the bank. Although because the first loss piece has been sold and there is now the Hercules guarantee, in practical terms, the cost is very low. The reality is that with 14-year contracts, there is no pressure for immediate sales. And I think some version of that is going to come to Cyprus just because of the size of the overhang.
But a number of portfolios have already changed hands, isn't it? So in Cyprus, you've had the two helixes, you had Marina, a number of other portfolios, and these are the portfolios that are feeding the market. And securitizations, you're right, they would barely come to market.
And that's why you have 20% reduction, like Lambros was saying, and not 1.5% reduction a year, like in some of these other portfolios. Mm-hmm. And you see more, but again, it's I think you have all these facilities that are springing up to make the market more efficient. But in the end, people have a business plan. They paid for that business plan, and they can withstand. They have some financing that is lower cost than their own capital. So not all of the buyers use fully equity to buy those portfolios. And so, in my experience, they need to find the price they like.
Okay.
So, do we have any other comments or questions? Okay, unless anyone has anything else to add, I think that that's it. Ladies and gentlemen, our today's discussion is now ending. Before concluding the discussion, let me warmly thank the participants, Mrs. Evgenia Christodoulou, Mr. Lambros Papadopoulos, Mr. Vasilis Theofanopoulos, Mr. Afxentis Zemenides, and Mr. Tassos Kotzanastassis, who took the time to participate in today's enlightening discussion on the very important issues of non-performing loans.
Thank you.
Thank you very much.